Welcome back to Financial Literacy for Lawyers, Bridging Law and Business. I'm Professor Seth C. Oranburg, and today we focus on the income statement. The income statement is the document most businesses use to show profitability over a period of time. But we're going to see how reported earnings can sometimes be misleading, hiding risks that explode into business challenges. We're going to build on our balance sheet snapshot from our last episode and train your newfound detective skills to spot when profits are more fiction than fact. And we're going to extend the movie analogy we introduced in episode 2. The income statement is a dynamic narrative that continuously changes, showing a moving picture of revenues, expenses, and net income. But just like a movie, it's open to creative editing. And that's why in our next episode, we'll talk about how the statement of cash flows gets us behind the scenes. If numbers still feel daunting, continue hanging in there. I hope you've seen that we're looking for patterns and concepts and not doing the nitty-gritty math. You don't need advanced skills, just curiosity and the basics we've covered so far. As we learned in the last episode, the balance sheet snapshot gives a moment in time view, typically at the fiscal year end. And now we'll see how the movie builds on that for performance over time. As always, this educational podcast is not legal advice. If you want tailored legal advice, consult a qualified professional. The income statement, also called the profit and loss statement or P&L, summarizes a company's revenues and expenses over a given period, typically a quarter or a year. It shows how much money the company made or lost by subtracting total expenses from total revenues to arrive at net income or net loss. This isn't just a tally, it's a narrative of how the business performed, and it answers key questions like how much revenue came from sales, what costs ate into those profits, and whether we're paying more for materials or for salaries. It finally answers what's left at the bottom line as profits or losses. Core components break it down step by step. Start with revenues or sales at the top. The money from goods or services sold is your top line, and that could include everything from product deliveries to subscription fees. Then you subtract the cost of the goods sold, or COGS, the direct costs like materials and labor, to get a gross profit. That's a measure of efficiency in production. Then we deduct operating expenses like salaries, marketing, and rent, and we call that operating income. And this shows day-to-day profitability. When you factor in what you're earning minus what it costs to make it, minus your day-to-day expenses, that's a day-to-day profitability or loss factor. And then we factor in non-operating items. So we might be paying interest on loans. We'll be paying taxes. And there might be one-time gains from asset sales. When you put all this together, you end up at net income, which is known as the final profit figure. Think of it as a movie reel of the company's performance over time, because we're seeing this given the performance over a quarter or over a period, unlike a balance sheet's frozen snapshot. Understanding these parts help lawyers identify where earnings could be artificially inflated or where expenses are deferred. Deferred means they're pushed to future periods to make current results look better, and there's all sorts of reasons why people want to push bad news into the future, including the CEO getting their bonus. For beginners, you'll start by scanning the top, which is the revenues, and the bottom, the net income. And that's your quick profit story. But as we'll see, the real insights and risks lie in the details between. Because although this seems like some type of science, there's a lot of art and judgment on when to recognize revenue or when to recognize expenses. And that decision of what fits into this period and what gets edited out and goes into another part of the story or on the cutting room floor, that can skew the moving picture. So earnings aren't always real, and I want to bust that myth. Companies sometimes manipulate income statements through aggressive revenue recognition. And by this, I mean they put book value, accounting value on sales where they haven't actually earned the cash. Now, this is allowed because of something called accrual accounting, which is what most companies do. But there can be excessive amounts of this and improper expense capitalization and treating costs as assets to spread them over years or hiding liabilities as expenses. Now, again, this is not going to be that course on how to do the forensic accounting, but I need you to be aware that there are a lot of ways to hide and manipulate some of what seems like profit. It's like there being a contract with a hidden clause that could void the whole deal, especially one which is written in white ink, turning apparent success into business liability and potentially misleading parties seeking remedies. Business risks arise when earnings don't reflect economic reality. This potentially misleads investors, lenders, and partners. Earnings manipulation has led to some of the biggest securities fraud cases in history, such as Enron in 2001, where mark-to-market accounting, which is jargon for valuing assets at current market value, even if you couldn't actually sell them for that amount, and even if you can't realize those prices, and they were doing off-balance sheet tricks that created basically illusory profits. It made it look good on paper, but it wasn't real, and it resulted in criminal convictions and billions in settlements. The scandal involved executives like Jeffrey Skilling and Andrew Fastow, who used special purpose vehicles, these entities that hid the debt in subsidiaries in complicated structures. And by the way, I talk about that in my veil piercing lectures as well. This $13 billion in secret debt led to Enron's bankruptcy and later Arthur Andersen's collapse. Similar issues plagued WorldCom in 2002, which capitalized routine expenses like line costs. It treated routine expenses like long-term investments and it put them in a different category, the result being an inflation of profit and loss statement earnings by $3.8 billion. And this fraudulent, or at least creative, $3.8 billion imaginary income led to CEO Bernie Ebbers' 25-year prison sentence, not to mention massive fraud claims. The fraud was uncovered when internal auditors found improper capitalizations of $3 billion and change in 2001 and another $779 million in the first quarter of 2002, which triggered a $100 billion bankruptcy. And this isn't just ancient history. More recently, in 2023, Silicon Valley Bank suddenly collapsed because they had overstated assets that masked illiquidity issues. And they had unrealized losses on bond holdings that weren't fully reflected in earnings. And none of this showed up until it was effectively stress tested by a bank run. And that bank run and basically needing to have cash that they didn't have triggered all sorts of regulatory probes and lawsuits. The bank held $40 billion in long-term securities that lost value as interest rates rose, leading to a $1.8 billion loss on their sale. This was the second largest bank failure in U.S. history. Or how about Hertz Global? In 2020, they restated 3 years of earnings due to material misstatements in depreciation. Depreciation is how much value drops over time. They had underestimated how much their vehicle value was dropping. So their fleet was worth a lot less in reality than it said that it was worth on paper. And they had to pay a $16 million penalty to the SEC amid board scrutiny. The restatement affected financials from 2011 to 2013, and it revealed over $235 million in errors from improper accounting for fleet maintenance and salvage value. Because legal counsel play a key role in due diligence, legal counsel must know how to spot these suspicious patterns. These cases show manipulated earnings don't just distort finances. They invite disputes, enforcement actions, and fiduciary breach claims, often starting with SEC investigations and ending up with criminal sentences. So, what are the legal stakes here? It's important to watch for revenue that grows unusually fast while cash lags, because this could indicate premature revenue recognition, which again could result in SEC and other violations. This is like promising a win in a deal before it's closed. You're booking sales that haven't materialized into cash, and there's going to be some melt that you don't actually see some of this. So you end up having a really good looking quarter, but eventually you got to pay the piper. The mismatch often signals sales books but not collected, and it could be fraudulent if this is done intentionally. Lawyers should be cautious of sudden drops or spikes in expenses unless there's a clear business reason. So if you see the income statement changing over time and there's a significant change, it's reasonable to say, what happened? If there's no good reason, like we sold off a bunch of stuff or tariffs hit our business, that's a reason to dig deeper. A spike could mean that revenues had been padded or there are reserves that now are not going to be valued correctly. And a drop could mean costs deferred to future periods, and you're going to have to pay eventually. So look for large or increasing general and administrative costs that are hard to categorize because they can mask operational problems. If there's unusual one-time gains or losses affecting net income, this could be like an asset sale boosting the bottom line temporarily. That's another reason to observe for a yellow flag at least. Consistent avoidance of reporting losses through adjustments is another tell. And so sometimes these adjustments are listed in footnotes, but the footnotes, as we know, can be important, as are significant changes in estimates and allowances without adequate disclosure, such as reducing bad debt reserves to free up profits. You know, I'm still giving you some jargon here, but what I want you to have is some confidence that if it doesn't look right, if the numbers change fast and you don't understand why, you should ask. That's your job, and it's totally okay. And it will piss people off because they might be doing something wrong that you're discovering, which unfortunately is also part of our job as lawyers. Additional red flags include declining gross margins without explanation. Why did the gross margins go down? You should ask. Gross margin is a gross profit as a percentage of revenue, and it shows core efficiency of the business. Why would a business be getting less efficient? Or if there's revenues tied to related parties that could hide self-dealing, like sales to affiliates at inflated prices. Any margins that are outpacing industry averages could also warrant digging deeper, like if a tech firm's margins are 80% while everyone else's are 40%. This could reflect unsustainable practices. Compared to benchmarks, you can use horizontal analysis to track year-over-year changes for consistency, or vertical analysis to look at how different people in the industry are performing over that same period in time. These aren't abstract signs, they're tripwires for business decisions. In Health South, there's a scandal in 2003 with ongoing appeals into 2024. So, yes, that's a long time of dealing with these problems. They inflated revenues and overstated them by about $2.7 billion through absolutely faked journal entries. This led to restatements and to executive prison time, but it was all traceable to patterns that were visible on the income statement. Founder Rick Scrushy was acquitted in 2005, but later convicted in a related bribery case. 15 executives pleaded guilty, and this all to me highlights how earnings fraud can unravel companies and careers. Footnotes and management discussions and analyst sections often reveal critical information about accounting policies and contingencies. It's like fine print in a contract that changes the whole interpretation. It can actually provide the why behind the numbers, and so it's important to dig a little deeper. You can check whether the company discloses its revenue recognition methods, when sales are considered earned, and this shouldn't change. There should be a consistent way of understanding when a company determines that it has made a sale and books it. You can also ask, what are the depreciation policies? Meaning, how are asset costs allocated over time? When you purchase a car, you don't pay its whole value up front. But how do you determine how you're booking that? And again, is there a consistent way that we're doing it over time? And we can also ask about reserve changes, which means any unusual transactions that can materially affect earnings. In 2025 in particular, we need to start looking out for environmental, social governance related disclosures as per evolving SEC rules. It's sort of interesting. Although we want companies, or some people want companies, to be involved in more corporate social responsibility by disclosing more environmental social governance, We now have more liability for these disclosures and more ways that executives can hide some of their slush funds in some of these ESG activities. And if they don't abide by the disclosures, they can be investigated by the SEC. Strong, transparent disclosure practices generally indicate less business and legal risk, but there's a lot of reasons why executives don't want to be transparent, including maintaining a competitive advantage. Of course, you could explain that clear explanations build trust and reduce the chance of disputes with shareholders. Poor transparency disclosures, like vague or omitted details, are a cue for more questions. If you don't understand what it says, other people probably don't either. And that's a real risk to the company. So go ahead and ask, what does this mean? Remember, footnotes are where companies bury the bodies. Overlooking them is like skipping the definitions in a contract. In scandals like Enron, the real story of special purpose vehicles and aggressive estimates were hidden there, but they were only uncovered after the collapse. From a business standpoint, the income statement underpins several critical areas, making it indispensable for your practice. The income statement directly influences outcomes in high stakes scenarios. First is a probability assessment. In due diligence for transactions, analyzing trends in revenues and expenses helps evaluate if a company's earnings are sustainable. It informs valuation, and that informs your negotiation strategies. The second is risk identification. Mismatches like high net income without corresponding cash flow, as we'll see in our discussion on the statement of cash flow, can flag aggressive accounting. And that can help prevent fraudulent conveyance claims or compliance issues because there might be a liquidity problem that isn't visible from this statement. And third, in contract drafting, understanding margins and expense patterns allow for better financial covenants, like requiring minimum profit levels to protect lenders or partners. And look, you have an advisory role. If clients are in a growth phase, spotting expense spikes early enables proactive advice on cost controls, bridging legal protection with business efficiency. So you're not just the bad guy, you could actually help save the business. In real terms, consider how these insights could have flagged issues and scandals like WorldCom, where capitalized expenses hid the true financial picture, leading to restated earnings and collapsed deals. So what's the practical takeaway? To turn this knowledge into action, here are some practical steps you, the lawyer, can take, with a bit more detail to assure they feel applicable. First, cultivate a basic fluency with the income statement's format and terminology. You could start by reviewing one from a client file today or grab one off the internet, noting the flow from revenues to net income. Familiarize yourself with some of the terminology. The terms like gross profit is just revenue minus direct costs. And spending a little time on a website like Investopia, just looking at the definitions, can be helpful. You don't have to do the math, but it's useful to know the jargon. Second, ask clients for explanations of unusual trends or anomalies. It shows that you're interested in their business, but you're also doing some investigative work that can keep them out of trouble. You could ask, why did revenue jump 50% last quarter? Or what drove that expense drop? These questions uncover if changes are business driven or mere accounting tricks. Third, when reviewing financials, cross check income statements with cash flow statements and balance sheets for consistency. We'll talk later about how to put all this together. But if earnings are up but cash is down, that's a yellow flag. You have to ask why. It could indicate uncollected sales or deferred expenses or what we might call overly aggressive accounting practices. Fourth, collaborate with accounting experts when needed. But still, you need to retain enough knowledge to ask informed questions and to issue spot when to escalate. Like if non-GAAP metrics overly adjust reality, you should be able to identify that. Fifth, scrutinize non-GAAP metrics, meaning non-standard metrics. If a balance sheet is not done with generally accepted accounting principles, you need to understand what principles were used. So if you see something like adjusted EBITDA, that's weird. EBITDA is a standard term. How is it being adjusted and why? Those sort of terms, adjusted, should flag to you that there's a question worth asking, which you can scrutinize, because aggressive adjustments often hide recurring issues. Regulators will scrutinize them if you don't. In our next episode, we'll turn to the cash flow statement, the behind the scenes footage that's the ultimate test of whether the numbers on an income statement hold water. We'll learn how to analyze cash flows to uncover hidden risks and support more sound business advice. And in the meantime, if you're looking for an exercise, jump on Edgar and download a public 10K. It's going to have a net income statement. You can trace the income back to revenue. See if you spot any one-time items, or take a look at the footnotes. What kind of disclaimers are happening in these public company statements? It's a simple way to practice and sharpen your instincts with no risk. The income statement movie may have twists and turns, but with your detective skills, you can uncover the true story and bridge legal advice with better business practices. I'm Professor Seth C. Oranburg, and this has been Organized.